What do you do in the market? I mean, valuation is already high. We're a stone's throw away from a record high. David Kudla, founder, CEO, and chief investment strategist at Mainstay Capital Management, joins us now. David, do you buy here around these record highs? Like, are we due for another pullback?
We're probably due for another pullback, Alex. I'll tell you, we're getting to that point where you kind of hold your nose and buy. And I say that because, we've got a PE multiple on the S&P 500 over 22. It's richly valued, but we've been richly valued for a while. We certainly were earlier this year. And if we have the geopolitical tension, what happened in the Middle East seems to have calmed down we have a tenuous ceasefire, but it's calmed down for now. We're going to have the tax cut package that is going to go through by July 4th or soon after. It's battling its way through Congress. We've got record buybacks, corporate stock buybacks, and the economy is strong. We've got a Fed on hold, but I think that's just the Fed needs to wait and see. Powell wants to wait and see how the tariff policy turns out. And that's probably the risk for the market is when we get towards that, July 8th, July 9th, they're not getting trade deals done, but do they get some done? Do they kick it down the road further so it doesn't become a big negative factor for the markets? But yeah, we're continuing to hold here, certainly, and continuing to buy. We think it's still a good time to be constructive on stocks.
What sectors or what factors are you guys focusing on these days if you are still buying?
Yeah, so, the thing that's really had an explosive move off the bottom in early April is the technology, AI type stocks that sold off so deeply. So that's been a good area for investors and that we've ramped back up as tactical asset allocators. We're constantly tactically reallocating portfolios. So we were a little bit of risk off on the way down and then risk back on the way up. What we've continued to maintain, though, is our exposure to gold. There are some factors there that we just believe there's a secular move in gold higher. So we have that in all of our tactical portfolios. The news we got today about NATO, they've agreed to ramp up their spending to 5% of GDP. We knew we had some fiscal stimulus coming from military spending from Germany and the broader EU. That's going to ramp up even more. Now, they have to get there over the next decade. But as they do that, that strengthens what I've been talking about on the show is our overweight in Europe, which is trading at a discount to U.S. stocks. We can get better valuations there. Their Fed is cutting rates. I'm sorry, the ECB, their equivalent of the Fed, the ECB is cutting rates. And so they have good monetary policy, and they're going to have fiscal stimulus that's going to be on for years into the future here. So there's really we think, still bullish case for Europe. And then, as far as bonds, we just think it makes sense to keep duration very, very short. We just think the risk there, the duration risk there, with what's happening with deficits and the debt in our country, it still makes sense to keep duration very, very short.
Going to Europe for a moment, how do you play it? Is it betting on the euro? Is it sort of defense stocks, or is it just the broad index?
Well, good question, Alice. We had, both things working for us at the beginning of the year. We had Europe in rally mode, a lot of the market, a lot of bourse over there in rally mode, and we had the dollar weakening. So we had both of those factors that help our overseas investments. The strength of the underlying securities or gains in the underlying securities and the FX portion, the currency exchange rate. What we may be looking forward to as we go forward. Right now, the dollar is still, it's weakened considerably, about 9% this year, the dollar index. It's weakening against the euro. If we see signs of a strengthening dollar, we might hedge those positions, right? Hedge the currency out of the equation. But for Europe itself, there's just overall broad strength there in the euro stock 50, 600. You can play that in a lot of ways. Certainly their defense stocks are doing well and are going to continue to do well with the military spending that they've signed up for.
David, you mentioned the dollar. The Bloomberg dollar index is off about 9% from its recent high start of the year. even though stocks have bounced back and some other risk assets have bounced back, what do you make of the dollar's, I guess, underperformance?
Yeah, we've had a reaction function this year for the dollar relative to rates, relative to what's going on. The dollar weakening under circumstances where it typically hasn't in the past. When we try to look at history, we do that in the eyes of what makes sense, the normal reaction function. What's happened is with all the QE that the Fed has introduced to artificially manipulate markets, some of those reaction functions aren't the same anymore. So it's getting very tricky on the dollar. There have been some shorts that have gotten hurt, some longs have gotten hurt because they're looking at traditional reaction function. Mm-hmm. We just need to monitor it very closely. For now, if the Fed does cut, we would expect that to weaken the dollar further. But we've had some odd reaction functions of the dollar based on what else is happening, factors that typically affect it.
All right, we got to leave it there. Really appreciate it. Thank you so much, David Kudla, founder, CEO, and chief investment strategist at Mainstay Capital Management.